Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. For the landscape of elevated asset prices that defines today, nothing may be more consequential than changes in the inflation outlook. And for Barry Knapp, the founder of Ironsides Macro, the Fed is off track with respect to its understanding of inflation in a post-pandemic world. While the COVID shock brought market volatility comparable to the breathtaking levels experienced during the GFC, the inflation aftermath of these two crises couldn't be any different. In Barry's rendering, while the GFC left household and financial sector balance sheets in disarray amid a damaged credit channel, consumer leverage is extremely low and lending is unimpaired in the post-pandemic period. By crafting today's policy as a function of the disinflationary decade post-2008, the Fed also fails to account for the positive supply shock in energy that was the Shale revolution, as well as the decades-long period of goods disinflation that resulted from China's admission to the WTO. The result, especially as supply chains are now being restructured, is the risk that the Fed runs consistently behind the curve over the coming year. As our discussion continues, Barry shares his view on the inevitability of a risk-off resulting from the Fed's attempt to normalize policy, a consequence of the degree to which market prices have become increasingly sensitive to even small policy changes in the post-QE era. I hope you enjoy this episode of the Alpha Exchange, my conversation with Barry Knapp. My guest today on the Alpha Exchange is Barry Knapp. He is the founder and managing partner of Ironsides Macro, a research outfit that he started a few years back and is keeping very busy with all the macro goings on these days. Barry, it's great to catch up and looking forward to the conversation.
Awesome.
So, lots going on at the Fed, lots going on in terms of changes in inflation dynamics, stuff we haven't really seen before. So why don't we get started this way? And I think we'll spend a lot of time just trying to piece through this inflation story. And I always use the comment from Janet Yellen herself saying it's somewhat of a mystery. Doesn't seem like a variable that we want to be a mystery, just given how much is riding on it. But you've got a lot of thoughtful and nuanced views on inflation and a view that the Fed is misreading aspects of the inflation picture. Why don't we start with the pandemic, since that's such a big kind of dividing line in so many ways, and walk us through your high-level framework for assessing what the impact is of the pandemic on inflation, both the sort of subcategories of inflation and then how that scales up to the big picture of it.
Sure. I guess I'd like to start by contrasting it to the global financial crisis. Keep this part of it succinct, but it's important because I do think that the initial policy reaction function was to look back. It's recency bias, right? So it's to look back at the last crisis and say, okay, things are probably going to behave similarly. And in so many ways, my research is titled, It's Never Different This Time. However, in so many ways, the pandemic and the global financial crisis are the antithesis of each other. I would describe the global financial crisis as a disinflationary or deflationary shock and a negative productivity shock. That was the thing that occurred to me as I read Carmen and Vince Reinhardt's presentation to Jackson Hole in August of 2010. It was an abridged version of It's Never Different. And what they did was they looked at 15 post-war financial crises, and the most persistent effect, and this got very little play at the time, but the most persistent effect of a global financial or a financial crisis is a decade of disinflation. It's that debt deflation, working off all the excessive debt that in that case was evident at both the financial sector level and the household sector level. Going into this, of course, we had low debt at the household sector level. They'd spent a full decade deleveraging, and the same was true of the financial sector. So your backdrop was very, very different. Furthermore, if you really think about inflation over the last 3 decades, service sector inflation has persistently been at 3% plus. Housing inflation has run, shelter costs, whatever we think of those measures, and right now we don't think much of them, has persistently run above 3%. There's been 3 primary deadweight sectors. I'd describe them as the healthcare sector, the education sector, and housing that have consistently had their levels of inflation grow above the aggregates, either PCED or CPI, yet they've taken up an increasing share of GDP. So they've been drags on productivity and they've been the drivers of inflation. Where all of the disinflation or deflation has come from for 3 decades has been through goods prices. And now goods prices have generally risen less quickly than service prices going all the way back to World War II. But what happened in the 2000s and then 2010s was particularly acute. Once China was admitted into the WTO, those prices started to really fall sharply. They sort of peaked or troughed at negative 2.5% in 2004. And this was all a function of this giant labor supply shock of integrating China into the global supply chains, global manufacturing. And so that effect was persistent, was acute, and was the reason that we had so much disinflation. We also, of course, had an energy price shock in the last decade. And you go back through the last 5 decades, we've had decades where energy prices pushed inflation higher and other decades where it created a big negative shock. The 90s, it was a negative shock. The 2000s, it was a positive shock. But the 2010s, it was a very negative shock, the whole shale revolution. So that was already changing as we were coming into the pandemic, as was the goods price disinflation. As global supply chains were already beginning to be restructured, we'd had a series of supply chain shocks. You go back to the Great East Japan earthquake and tsunami in 2011. You look at the Thai floods in the same year. Then, of course, we had the trade war, and then the pandemic was the supply shock to end all supply shocks. So there's a real strong view. And I think the Fed is waking up to this. I've heard Powell reference it in press conferences, and it appears to me that they've now begun to accept this idea that supply chains are going to get restructured from what was referred to for decades as just-in-time delivery to just-in-case supply chain management. And so that dynamic was secular in nature, and there was strong evidence that that was going to be the case going all the way back to 2011, 2012. Boston Consulting Group, McKinsey, a number of other think tanks did studies about how it just didn't make as much economic sense to stretch your supply chains all over the world. So that secular trend was already in place. And then, of course, you created a catalyst to restructure these supply chains. So if you think then, and you fast forward to where we are now, and you even look at the latest rounds of inflation data, the August CPI or August PCED reports, I see 4 separate categories. The first one would be the reopening related categories, airfares, used car prices, the ones that were very, very impaired during the height of the pandemic, then had extremely sharp snapbacks ranging anywhere from 20 to 50% annualized increases off those pandemic lows. Those started to soften a bit in August, and that's why the head or the core CPI month-on-month number missed, obviously didn't miss for PCED. But then if you look to the next level, which is supply chain related sectors, even areas like television and new car prices, for example, those are starting to pick up momentum and prices are increasing. They're not decelerating at all. So you've got that issue, and it's become very clear that the supply chain problems are going to persist longer. And if I'm right about the secular trend, it's highly unlikely that those sectors will ever go back to the level of disinflation that we evidenced the last 2 decades. Then you go to my deadweight sectors. Medical care has been negatively contributing. Education's been negatively contributing. And the housing measures are quite a bit softer than you would expect given various measures of rents that are around. And of course, 20% annualized increases in house prices. So you could argue with the construction of those, and I do think they'll eventually get restructured and they'll be more responsive to rents and house prices. But those are headed higher, and they're headed higher from the 3% current level that most of these shelter measures are at, or 2.5 to 3, depending on how you look at which ones you look at. They're probably headed to 4, and they're likely going to stay there. This is a very different housing situation from the last time we had this level of house price appreciation. You had much lower correlation in 2005, 2006, late in the housing boom. You've got super high correlation now. The 20 cities in the what used to be Case-Shiller is now CoreLogic indexes are running at 0.97% over 6 months and 3 months. Everything is going up together, but there's not a lot of leverage underneath the system. It's being pushed by pandemic-related issues. It's being pushed by Fed purchases of agency mortgage-backed securities and rates that are lower than they would otherwise be, but it's unlikely to turn around and slump. And so it seems highly probable that those housing measures are going to push considerably higher. And when we get to 2022, where we may have some base effects that make the housing or the aggregate inflation numbers look better for a time, that's going to be as dismissible as the base effects initially were in the second quarter of this year, right? That made the numbers so high. The net of all this is I don't see it being probable at all that we go back to a 1.5% trend for core PCED. I think it's 2.5 or more. Jason Furman was on CNBC last week thinking it's 3. It could be more than that. And then, of course, the final issue is energy. And it's highly unlikely that we are going to have a negative energy price shock or supply shock, positive supply shock, negative price shock. And most likely, given government green policies and ESG policies and the discipline that's likely to persist in shale production, we're likely to have energy positively contributing and it becoming a persistent problem that may actually pass through as it used to do back in the 50s and early 60s. So I think when you think about those sort of 4 categories, which is goods prices, service prices, those deadweight sectors, supply chain related, I'm naming more than 4, but it's essentially 4. And then the energy prices, you've got an argument why the decade of the 2020s is going to be a much stronger period for prices than we've had probably going back any time since. I'm not going to talk about the 70s yet. I think the 60s are a more appropriate analog, but we're looking at a very similar situation, I think, to the 1960s.
Well, I want to get into this potential misread that the Fed and policymakers may have with regard to the sort of post-GFC playbook and looking at that and thinking the same thing is appropriate for the pandemic. And you point to them being antithesis type events, even though they imparted so much volatility in asset markets, but they're very, very different in a lot of ways. And I wanted to go back to housing because you made a point, which I was hoping you could dive into. I know you've done some work on this notion of correlation across different, whether they're regions, cities. What are you seeing in that? You mentioned relative to, let's say, 2006, and what's the read through for you there?
So this was an idea that I originally conjured up back in 2011 when I was looking for evidence that house prices were bottoming. And so we took what was the Case-Shiller index at that time and the 20 cities that comprise that, and we ran a correlation matrix and then looked at the rolling correlation over 3 months, 6 months, and 12 months. And our thought was, and what we were solving for our Bayesian prior, was that you were likely to see correlation falling in as much as excess inventories in Vegas were no longer impacting prices in Phoenix. And we had lots of anecdotes that the Phoenix market had cleared, but Vegas hadn't cleared. You had recourse versus non-recourse cities and states. And so our idea was if correlation was falling, that's what it was telling you, was that we no longer, prices were never supposed to be correlated in housing. That was part of the mythology that led to the global financial crisis, right? Because ultimately they did prove correlated. But in 2011, the correlation did collapse. And in fact, prices bottomed. So when in 2011, we had that giant consumer and business confidence shock associated with the U.S. sovereign rating downgrade and debt ceiling debate. And there were all these catastrophic forecasts for what was going to happen to spending and all. It didn't turn out that way. And the reason is because the primary asset for most of the country had stabilized. And so we had a stronger than expected back to school selling season. So I started thinking about that correlation frequently. And in most cases, it didn't tell you very much. But if you go back to the second half of the 2010s, 2015, after house prices finally stabilized and mortgage credit stabilized, and you get to the second half of that decade, what you saw was very low correlation, like 0.2 amongst all those cities, and 5% house price gains. I think that's probably an optimal situation for the Fed, right? Or for the country, is just to have prices rising and falling based upon various demographic trends or whatever is the local driver, while you have, reasonable price appreciation. But of course, during the pandemic, the actions of the Fed, purchases of 100% mortgage-backed securities, is a likely explanation for correlation running at 0.97% and house prices rising 20%. Of course, none of this proves what the cause is, but it sure looks like some large macro factors are what explain that level of high correlation amongst all those cities and high house price appreciation. So, in fact, correlation is much higher than it was in 2005, 2006, and prices are rising marginally faster than they were during that time period as well. So it certainly argues for less intervention. And that's a point that Rosengren made that I thought was so powerful, which was, and this is going back about 8 weeks or so ago, when he said that interest rate, policy works through the interest rate sensitive sectors of the economy. So housing, autos, and durables. And those are sectors that are not wanting for demand right now. They're supply constrained. So having a policy that boosts demand in interest sensitive sectors is exactly the wrong policy at present. And I think Rosengren was spot on that. And I heard an anecdote actually in the aftermath of his resignation that at the end of every FOMC meeting, he spoke last. He summarized what everybody else said and then gave his own views. And he was highly valued within the FOMC. So whatever you think about him trading REITs, he was a loss to the FOMC, just as Rob Kaplan was, who was a former head of the mortgage business at Goldman Sachs and understood what the large-scale asset purchases of mortgage-backed securities, what the implications of those were.
Well, with that, let me actually shift gears a little bit, because that's interesting, right? That's new stuff with regard to the Fed. Two senior policymakers resign. A third, the number two guy at the Fed, Friday, has done what seems to be a very planned in advance trade. In fact, my understanding is Clarida's trade was from a bond fund to a stock fund. The absolute worst thing he could have done at that time. Right. It cost, at least on a mark basis
about a month early, right?
Right.
Yeah.
But that doesn't matter. The optics and the way in which the country kind of consumes information, it may not even matter. And so my bigger question is just around the Fed. In conjunction with some of these resignations, the Powell reappointment odds on one of the betting sites has gone from 90 to 60, I want to say. Tell us, in your eyes, what the sort of broad picture looks like in terms of the Fed, its leadership. Do you feel like these recent resignations are a significant deal? And does that become a little bit of a part of the market risk dynamic that wasn't the case maybe 3 months ago?
Yes, it for sure is. Now, I'd start by saying that there is very little true capital markets experience on the Fed. I looked through the current members of FOMC after Kaplan and Rosengren's resignation, and I went through everyone's background to see who had any capital markets experience whatsoever. If you count Powell's experience at a private equity firm as investment management experience, although that's not really investment management experience in the sense that I'd like to see it. Monetary policy works, particularly in the era of QE, works directly through the Treasury market and the mortgage-backed securities market. My preference would be that you have people that are experts in either managing bonds or either sell-side or buy-side experience in fixed income, because that is how their policy works, right? So there was about 3 people with some level of investment management experience and no one with any sell-side true investment banking experience. So they, yes, you could say the staff spends time looking at that and all sorts of meets with lots of people in the street, but there's no one who ever sat in those seats. So to me, that's a little bit of a risk factor. Rich Clarida is my understanding, was never likely to be reappointed. However, Rich Clarida is probably the most intellectually influential of all the board members. He's got obviously a tremendous background. He's been in academia, he's been at the Fed, and he's been at PIMCO. And so Clarida's departure is a real loss, but that was always likely to be the case. I do not believe that any of this, it appears to be, based upon some of the conversations I've had with various policy people that spend all their time watching the Fed, Powell is still more likely than not to be reappointed. So that, predicted market, it's probably not that far off. It's probably 70% or so. And I do think that Fed policy is very much a battleship, and that battleship has set sail. They are ready to start the tapering process. It's likely to start in November and continue through mid-year next year. And no changes in personnel will halt that. First of all, in the short run, it could have an effect if Powell's not reappointed. I think that's fair that the markets would get concerned about that. But that's a short-term psychological effect. I think in the longer run, this Fed was always headed down a very similar path as the Fed in the 1960s, where at that point they had very little in the way of staffs, and the focus had clearly been on inflation. The Kennedy administration brought quite a number of new Keynesians into the system, and the emphasis shifted from the inflation part of their mandate to the employment part of their mandate. So that was already underway at the Fed before this whole scandal happened, and it's likely to move even faster in 2022. So I still, when I think about, okay, how is that going to impact policy? The taper, as I said, I think is on autopilot right now. But when does liftoff come? Is the Fed consistently behind the inflation curve through the 2020s? I thought that before, and I have even more conviction after the trading scandal that will indeed, if you want to call it that will indeed be the case. And by the way, the market is traded like that. If you think about what happened in the last week or so, we had real rates move sharply higher. You also moved the terminal Fed funds rate up about 35 basis points. So that's a recognition that the Fed's about to start. But the curve, the nominal curve, steepened at the same time. And that to me is all consistent with what I just said, which is, okay, they're going to take the first step. They're going to taper asset purchases. They were buying 100% of the supply of TIPS. So when they obviously stop doing that, real rates are going to move higher. Every one of my bond clients I talked to would just lament how the real rate curve was in the wrong place and real rates were crazy low and so on and so forth. So you move those real rates up, you move the terminal Fed funds rate higher because you have this recognition they're finally going to start. However, the curve steepening tells you investors still think that this Fed is likely to be behind the inflation curve, so to speak, through the business cycle.
I think there's so much content or so much perspective you can gain from just prices. And one of the things that I found particularly striking last Tuesday was it was only the fourth time that you had S&P and TLT both down 1.5% on a given day, and the VIX up 20%. And I just think we've had this, almost 4 decade tailwind of low rates and this magic of the positive carry hedge, right? We've been taught of duration as this stabilizing force that also delivers positive return. And here it is falling on the day of a big risk off when the actual hedge, the VIX, goes up 20%. And so you just don't see these days very often. And I think this is where the market may struggle. This is where the transition to some new risk environment can be quite uncomfortable. And I wanted to just ask you about the Fed, and you said use the term behind the curve on inflation. What might that look like from a tipping point standpoint? If you're right, and this notion of the transitory inflation is just not the reality, and it's this time next year, and we're still in the 3 to 4% range, what does that look like, do you think, from the Fed standpoint? When do they cry no mas, and how does it look? How do you see it materializing?
I would again point to the early 60s analog where we had very much of a similar dynamic. We had aggressive fiscal and monetary policy. Bill Martin was chairman of the Fed. He believed that the Fed was independent within the government, not of the government. So it was never really free to not at the beginning, calling it monetization of growing federal deficits is a little unkind. It ultimately became that, but that was the environment that we were in. And I think this is likely to be very similar. I mean, just think about all the arguments we hear from, very thoughtful economists about how, we were too focused on the inflation target and we should have been more focused on the employment and inclusive employment, and we should allow inflation to run hot. And there's almost this sense that they really do have the tools to control it. The Fed says this all the time. They do have the tools to control it, but the question is, will they have the political will to control it? Because ultimately, that's what happened to Bill Martin and Arthur Burns after him, is until Paul Volcker, no one had the political will to deal with the rising inflationary pressures. And it's highly doubtful that this Fed would in the early years. And so what ultimately happened for asset markets was fascinating, in as much as you'd had this very uneven, weak capital spending environment in the 50s with a raging bull market, right? We went from a 7 PE to a 20 PE from the end of World War II to the time that JFK was elected. But earnings growth, which had run at 8% roughly through the 50s, accelerated to 15% in the early 1960s. And it lasted like that until 1967. You had stronger nominal growth, you had stronger revenue growth, positive operating leverage, fixed costs don't need to get replaced right away. And so the equity market managed to stay at that high multiple with good returns because earnings growth was faster. Ultimately, that collapsed into a much more rapid inflationary environment, which crushed valuation of multiples. But through that whole time period, bond returns were negative. And so that was a period when the 60-40 model didn't work. I saw someone sent me recently a LinkedIn post from a former client, a guy named Rich Excel, who was an O'Connor person, I think, at one time. And Rich was talking about this positive, stock bond correlation over time and postulating something similar to what I have been, which is that the Fed is in essence killed the 60-40 model, that when you suppress rates to the real rates to the level that you did, as that pressure comes off, bond returns are just likely to be negative. And if I'm right about inflation, they'll persistently be negative through the 2020s, in which case using treasuries to hedge your risk portfolio, your equity portfolio, just won't work, right? So the episodes you've pointed to are the sort of risk parity not working or the 60-40 model not working. And I think that's going to be, for me, that's the likely trend through the 2020s.
I think it's BCA has done some good work on trying to tie back that regime of stock bond correlation, which of course changes over time, where we had the positive correlation, which was 80s and 90s, and then certainly probably post 2000 and certainly post the financial crisis, it got deeply negative stock and bond daily correlations. But BCA has tied it to inflation. Basically, when inflation is pushing higher, that stock bond correlation is subject to change. And now you have, a circumstance in which the risk-free asset itself may be the sponsor of the risk event. And this is an area I wanted to really get your thoughts on, which is low rates and high asset prices. In some ways, they're inconsistent with each other, but maybe they're very consistent. Maybe it's the low rates and capitalizing everything at these low rates that create the high asset prices. I just wonder where you come out on how impactful low rates are for all of these things, whether it's S&P 500, art, NFTs, real estate. Is it all a function of low rates? Like, how do you think about low rates and high asset prices?
I think that the reach for yield dynamic as a consequence of monetary policy is a real thing, to be sure. I had done a bunch of work back in my Barclays days about where I looked at the equity risk premium of bond-like stocks relative to the equity risk premium of economically sensitive cyclical stocks during the heaviest period of QE after the financial crisis, so 2010 through the taper tantrum of 2013. And what I found was the equity risk premium of bond-like stocks, defensive sectors, utilities, REITs, and the like, didn't compress all that much. But as you drove 10-year real rates from plus 100 basis points to negative 100 basis points, that drove, the price of AT&T to 20 times earnings with no growth and yield on utility stock down to, say, 3%. And so you really did have an effect, whereas the equity risk premium of the economically sensitive sectors actually rose through that period. I thought that was a pretty interesting observation. So there's limitations to, this reach for yield dynamic. There's definitely parts of the equity market that will benefit from it. The other parts, the more economically, particularly super economically sensitive sectors, they do need earnings growth, right? I mean, no one's going to say, I got to pile into energy stocks because, except for maybe a couple of them with big dividend yields, but certainly not E&P names or otherwise if you think, well, Fed policy is super easy. But what happened this cycle was even far more extreme than last cycle, right? I mean, we took real rates to levels across the curve that we didn't get close to last cycle. And so, it did start to manifest itself in a whole bunch of other asset classes that you point out. And it's a powerful force, to be sure. You basically make carry less than free. You make it so positive that people do start speculating in lots of different areas. This is why I've been so insistent that the end of QE, we could not get to the end of QE without a risk-off shock. And, I got trolled after going on CNBC about this. And, people would constantly tell me, well, we know it's coming and the Fed can prepare us for the psychological aspects of it. And who cares because the levels are so low. It's just not how markets work. And there's from my perspective, three channels that the QE process really works through, three obvious ones. One is, it's clearly the psychology of when does that mean liftoff on zero interest rates is going to come? What does it say for that? And listen, the Fed's, in essence, pre-announcement that they are going to start tapering asset purchases in November, it did reprice that liftoff or the terminal funds rate, as I mentioned a little bit earlier, and it pulled in liftoff. So it had a negative effect on that part of the transmission mechanism. But then the second one was the fact that they were buying 100% of the supply of TIPS, and they drove real rates to unprecedented levels. So as soon as they stopped buying that, I'm not sure who's buying 10-year real rates at negative 100 basis points. So it is going to shock real rates higher. And of course, we had two shocks to real rates back in 2018, a 30 basis point move higher in January, and Volmageddon followed right after. And then another one, similar move in September. And we had the global QT crash, right? Because the ECB, DOJ, and Fed were all trying to normalize their asset purchases at the same time. And then the final channel is the volatility channel. And that's the fact that the single biggest source of volatility in the rates market is mortgage prepayment risk. When the Fed buys 100% of the supply of agency mortgage-backed securities and doesn't hedge convexity risk the way even Fannie and Freddie did pre-crisis, once that ends and that risk, when new mortgages gets created, winds up at, Goldman, Morgan, Bank of America's, everybody else's winds up on their mortgage desk, VAR is going to get cut across the franchise, and that's going to permeate out through the system, and you're going to get a volatility shock starting with rates vol that permeates out to other asset classes. As we know, biggest VAR users on the street are the mortgage, in normal times at least, the mortgage desk, and then the equity derivative desk. And the rate of change of VAR and vol is huge in those areas. So that's where the vol shocks come from. And in fact, when you look at how those risk-off events unfolded post-QE era and pre-QE era, if you look at 94 and 04, for example, you had less highly correlated, you had sell-offs of roughly 8-9% in the equity market. They weren't super highly correlated when you look at them on a sector-by-sector basis, but they were pretty good risk-off shocks. Post-QE, they averaged more like 12%, and they were highly correlated risk-off episodes. And that's because of the vol effect, in my view. So there's just no way to really get around that.
It is so interesting to think about the Fed entangled in markets, basically setting certain prices. As you suggest, the very powerful, as some call it, open mouth operations, right? Just listen to what I'm saying, even if I don't do anything. Maybe it's like the Hank Paulson, if you have a bazooka in your pocket, that can be powerful in setting expectations. And as your research has shown, these risk-off shocks have become more frequent and sharper in terms of the Fed. So you've been calling for something more than 5-ish%, which has really been where people have focused their attention. Maybe it was because it was literally a year to the day of without a 5% drawdown from, I think it was Sep 3rd of 2020 to Sep 3rd of 2021. We finally got the 5%er, which now we're through. And the Qs, it's maybe 8.5% now. But you're thinking the S&P goes to something closer to 10%. And so tell us, why? I guess that's some of your research. And then two, how does that resolve itself? And is that a buying opportunity? How are you squaring those?
The basis for thinking that it's, a little more than, I've been calling it 10 to 12, and that's based on that history. So every business cycle since World War II had one of these, call it Fed policy normalization related shocks. And I traced them all out, looked at the first Fed move, and looked at all these little corrections going back through every business cycle. And they averaged about 8% before the QE era. After the QE era, we actually had 8 of these. So going into the year, my expectation was we could have, periodic pullbacks at the beginning of the year based upon sentiment positioning, but they'd be contained to 4 to 6%. And it was largely based on the history of Fed policy normalization related corrections, business cycles. Typically the first big pullback, roughly getting close to 10% would be when the Fed started normalizing policy. That's looking through every business cycle since World War II. Those corrections got bigger after the global financial crisis. Part of it could be because we were in a fairly sluggish growth environment, but generally it appears to me, based on my work, that it had more to do with the Fed pulling back from asset purchases, because the biggest of those 8 pullbacks we had last cycle, as opposed to 1 each of the prior cycles related to the Fed, they were larger and they worked through these volatility channels and real rate channels that I mentioned. So for me, then I thought, okay, when we finally do get to the point where we get policy tightening, either fiscal policy tightening because we get a significant tax rate hike, but more likely Fed policy normalization, the end of asset purchases, the start of the tapering process, we would have a 10%er, 10 to 12%er based on that history. Now, the question is, if we just grind down 10%, and you and I have talked about this a little bit, is that going to be sufficient for the market to be washed out from a positioning perspective? And I think the answer is that depends. Certainly, the biggest of those pullbacks we had last business cycle came in 2011 when we had simultaneous fiscal and monetary policy tightening. We could certainly have that this go around, in as much as, from my perspective, this next round of fiscal is far from stimulus taken from the perspective of an equity investor. It's quite the opposite. You're paying for a social safety net type of thing, which may have some effect on the economy over time, although none of the think tanks that score these things views that to be the case. Even in the case of infrastructure, like Penn Wharton budget model views it as a slight negative for GDP over time because of the borrowing costs, but you're paying for it with corporate tax hikes. So that's a net negative. So could it be larger than 10 to 12? It's possible. My tendency, though, is to think that the underlying growth outlook is far more robust than last business cycle. And, think about the condition of the consumer, think about how strong a back to school selling season we had. And that generally correlates very well to holiday sales, which, although we might have a bit of a supply problem for the holiday season, we're still going to have very strong underlying demand. By all accounts, that's true of the labor market, that's true of autos, that's true of a whole range of sectors. So my expectation is that we will have good underlying economic support. We may even get a bottoming out of earnings net revisions and be in a position to rally once we've really shaken, and I don't want to use the word complacent investors, but investors that were a little over their skis long, once they've been completely shaken out of all the various sectors like technology. Once that's occurred, we've had a good 10 to 12%, or chances are it's going to be a really good buying opportunity, would be my expectations. But, it was always inevitable that we were going to have a risk-off event when the Fed tried to get out of all their asset purchases.
I'm sure there's better ways to look at it, but certainly a lot of focus has been on the PE ratio of the market, both on a spot basis and a forward basis, and putting those in extremely high percentiles. When you step back and just look at the valuation metrics that you think are appropriate both across sectors and just for the market as a whole. Give us a sense as to your sense of its priciness, or whether that's a kind of an overstated news item that's covered.
One of the lessons I learned as Barclays equity strategist in the last business cycle, as a guy that started out 2009 saying that we were going to retest the lows as opposed to everyone else who was out there who said, no, the bottom is in. We did retest the lows, but then I got very, very focused on valuation and relative valuation, stocks versus investment grade credit and the like, and underestimated the power of the business cycle. So I was determined this go around not to get run over by that same dynamic, which is at the beginning of this year, the S&P 500 estimate was 163 for 2021. We're at 202 now. I mean, it's up 23%, right? So no one really had that big of an earnings recovery that quickly penciled in. So you have to be careful about getting too carried away with valuation early in the business cycle. Once you've gone, though, you've made that transition of mid-cycle. For me, that period is marked by that first Fed policy normalization step. When that occurs, now you're into the middle of the business cycle. Then you can really start thinking about valuation, relative valuation. When I look at that, the sectors that really stand out are the economically sensitive sectors. The ones I expect to work through the business cycle, because I do think this is a reflationary environment. So financials are cheap. Energy looks cheap, at least on a relative basis. They're cheap to bonds. They're cheap, on somewhat of an outright basis relative to the rest of the sectors. That's the stuff that really should work, in part because their earnings momentum should be good in a reflationary environment. So the equity market can hang around, upper teens, maybe even 20 times earnings, if I'm right. And we do have 15% trend earnings growth, not 8%. And that's not so unusual, by the way, because the average post-World War II, if you take out recessions, is more like 12.5. So we've had these eras like the early 60s where you have strong nominal growth, you have strong earnings growth as a consequence, and you could grow at 15%. We could stay at relatively high valuations if we have that kind of growth, at least for a time. But for me, I would still favor the more economically sensitive, which also happen to be somewhat cheaper sectors as well.
And how does inflation fit into that?
My idea here, though, just to be clear, is that we don't go from decades of disinflation straight to inflation. You don't skip the 60s and go to the 70s. You have a period of reflation where we have stronger nominal growth. A bigger portion of that is prices, right? But 3% inflation, 3.5% inflation, 3 to 4 perhaps even, is manageable for the corporate sector. It's once you get beyond that threshold that it starts to get ugly. In fact, even that paper that came out from the Fed official, that was pretty racy for a Fed paper 2 weeks ago about inflation expectations being non-meaningful, he argued something similar in terms of the inflation threshold, which is inflation expectations may not matter until you get to 4, but above 4, they could matter a lot. And so it's the same sort of argument that if we have a period in 2022 where, it settles down, but we don't really get back down below 2, we stay at 3, something like that, the corporate sector will probably be able to operate pretty well. In fact, a lot of companies are going to thrive, just because until you have to replace your fixed costs, you get stronger revenues, you have operating leverage, right? There's the fixed marginal cost argument, and then there's the operating, fixed cost versus your top line fixed cost argument. That's actually a bigger percentage of total costs. It's not true for every sector. We're seeing lots of negative pre-announcements right now of companies that's not true of, but for the market as a whole, it is true. And so, we could have a period of a couple of years where the market does okay as a consequence. But if that inflation impulse keeps going, that's ultimately where valuations get absolutely crushed. And so the question is, do we get to the 70s or not? And if we are going to get to the 70s, how quickly do we get there? I've been postulating just using history to say, well, it could be half a decade or something, but that's highly uncertain, right? I mean, no way of knowing.
I've been following these Citibank inflation surprise indices, which they post on Bloomberg, and there's just a long history of them. No surprise, most of them are at an all-time high. And no surprise as well, they've become more correlated to each other. So if you look at a correlation matrix from, take your pick, back 10 years or 20 years up to the end of 2019, it's a vastly different matrix of correlations for the 20 and 21 period. You'd mentioned margins, and I just was curious because one of the inputs into the U.S. City Inflation Surprise Index is average hourly earnings. And I'm just curious, as you look at the earnings picture, how does that figure into corporate behavior, your view on expectations, both from the workers' demands for what they want to get paid or can get paid? And does that ultimately filter in? They say that earnings are more sticky in terms of the inflation outlook. Tell us your view on that.
If you look at the source of soft wage growth using that average hourly earnings series through the 2000s and 2010s, you can point directly to the global labor supply shock from China. We went from 750 million industrialized workers in 1990 to 2 billion by 2010. And the way I would illustrate that and have illustrated it is by looking at average hourly earnings for non-supervisory workers, which the headline AHE series only goes to 2006, but the non-supervisory series goes back to the early 60s. When you look at manufacturing sector, you could see serious wage disinflation. I then used wholesale trade and transportation as my sort of leading edge of that manufacturing sector. Both those were headed, lower through that entire time period, beginning in the early 2000s, and finally bottomed around 2017, 2018. That dragged the service sector and aggregate the overall measure with it. That started to turn in 2018. This is why I argued earlier that a lot of these secular trends were already in place. And they were headed up fairly significantly before the pandemic even hit. Now they've taken a level shift higher and are trending significantly higher. So I think that period of wage disinflation is done. Furthermore, when you use the Atlanta Fed wage tracker series and you take the lowest income workers versus highest income workers, you see something very similar, which is a bottoming around that same time period and the lowest wage workers' wages rising much faster. If you then think about the effect of the pandemic and you look at the ADP data looking at large, medium, and small businesses have hired back almost all of their workers. Large businesses they're at like 70% of the job losses. Maybe it's 60 actually, whereas it's much, much higher for small businesses. So this is going to be a problem for average service sector type companies, although there was already a trend underway to substitute capital for labor. And I've pointed to examples like Starbucks, where they now get a third of their customers to buy the product before they walk in the door, paying a human being for a cup of coffee in Newark Airport Terminal C, right? So you do have some productivity offset to this in consumer services and consumer goods, but it's an issue. Now, I would go again back to the early 60s period where consumption held up pretty well during that early period because consumers really focus on their nominal wage growth. So if nominal wage growth is going up, they tend to spend. Eventually, when inflation gets too high, then their real wage growth will matter, but they won't notice it initially. So from a corporate perspective, there's some levers to pull for a time, right? Technology innovation adoption, substituting capital for labor. We already had faster productivity growth very late last business cycle. That's likely to persist. I said early on, but didn't explain why I thought the pandemic was a positive productivity shock, not a negative one. This is part of the story. So that's a bit of an offset on that wage dynamic. But again, if it becomes too hot and persists for too long, then there's only so much you can do in terms of capital for labor substitution. Then again, it becomes a much more acute problem. And so my expectation is it's manageable in the early years, but we'll see. We'll just see how quickly we move from reflation to inflation if we are indeed going to do that.
One of the aspects, I think, of your skill set that people really benefit from is this not just real deep appreciation and knowledge of economic history and the way that policymaking institutions like the Fed work, but also you've stared at asset prices themselves for a long period of time. And so I'm wondering, when you look at the grid of asset prices, the mosaic of macro variables, What sticks out to you as a head scratcher? What are the either prices on a absolute or relative basis that you struggle to make sense of right now?
I understand why this is so, but I do think it's going to change and change in a very significant way in coming years, which is the lack of exchange rate volatility. So, during the pandemic, we had very synchronized developed world and even non-developed world, emerging world policy responses to the pandemic from at least a monetary perspective, the types of things that you would expect to impact exchange rates. But I expect us to find ourselves back in some low-level currency wars over time, and not even over time, probably over the next 6 months or so. Furthermore, the dollar has changed in as much as the dollar looks more like a petrocurrency now than it has in a very, very long time ever, right? Because we really haven't had floating exchange rates since World War II. Think about the dollar advance over the last month. There's only 3 currencies that the dollar didn't advance against of note: Russian ruble, Canadian dollars, so petrocurrencies, and the Chinese yuan. And I speculate the reason the Chinese yuan didn't fall is because they already have outflow pressures, which are taking place through currencies. It's a consequence of Xi's crackdowns, and were the currency to start to decline, that those outflows might turn into a flood, right? But so, we've got the issue with the renminbi, then you've got the euro, the yen. This has, been an underlying tension for a long time. The Biden administration is going to be less contentious with respect to that than the Trump administration, certainly. But this will become a major point or sore point if ECB and BOJ actions are such that they're really trying to weaken their currency to export their way out of, their sluggish growth. And so I think exchange rates are an area to watch for sure. The other, for me, most notable thing is that coordinated activity, along with the Fed purchasing 100% of the supply of agency mortgage-backed securities, meant we had suppressed interest rate vol, we had suppressed exchange rate vol, credit spreads were crushed initially. Fed purchases helped, at least from a psychological perspective, but also a lot of the actions meant that there were no bankruptcies or of any note through this cycle, the PPP program and the like. So you've got all these risk assets that are very suppressed, right? They're, if you look at them over 10, 20-year periods, they're trading well below their median levels of risk. And that leaves the equity market as the only outlet, an equity volatility market is the only outlet to express any kind of risk appetite, right? So we've had, until recently, SKU's come off a little bit, but SKU's been persistently rich. That's very different than after the financial crisis when it was really cheap. I speculated back in those days in 2010, 11, SKU was cheap because nobody took any risk, right? Managers were closet indexers and investors had a lot of cash, and that opposite situation is true today. So SKU would get rich, and then, we'd see these vol spikes, and it was really the only market of any consequence where you could express a view and you weren't fighting the Fed directly, at least. So for me, that was another sort of interesting observation that I would now then expect that vol would really come back in a major way in the fixed income market and probably exchange rate markets. And you could very well, in the risk off, we've seen some widening of credit spreads on the high yield side, at least. By the time all said and done, you could see a pretty good move in high yield, actually.
The FX vol market comments certainly resonate with me. I mean, you can count on one hand the disruptive events over the past decade, right? The euro in 2011 and 12. You had, a couple of things in maybe more the EM side. Brazilian real, that got bid a couple of different times. You had, of course, the Swiss unpegging. The yen rallied like crazy on the back of the nuclear accident. So there's not many of those. It's been a real sleepy asset class. That's really interesting to hear. And on your, risk can't be contained, right? It can't be destroyed, only just changes form. And it could be that the equity derivatives market is the only real outlet these days. I wanted to ask you this just on the business of Ironsides Macro and running a boutique versus your experience at bulge bracket places like Lehman and Barcap and BlackRock. What are clients asking you for in terms of their trying to understand the markets better and trying to be positioned for change. What does that look like in terms of the types of questions that clients are relying on you? And how has that possibly changed versus the dividing line of March of 2020 and the pandemic?
First of all, from the perspective of why would someone come to Ironsides, obviously I've got long periods of relationships, but I have a really diverse background. When I was an equity strategist, it was a unique background. Most of my competitors in those days had been fundamental analysts at one time. That was true of Tom Lee. It was true of the late Tobias Levkovich, who I thought the world of, Adam Parker at Morgan. They had all been, David Costin had all been fundamental analysts. I came out of an equity derivatives and trading background, and that was unique. And then I went on and helped manage fixed income money. And so I've sat in a similar seat. And so it is a broader background. And I do think to a great extent that a lot of the street research, it was always compartmentalized. So you always had to be a little careful when you cut across and had strong views in other asset classes. But that wasn't really a big problem for me at Barclays. I spoke to all my fellow strategists and had my own views and was always careful not to contradict them. But it seems to me that the street has become far more cautious with respect to ever criticizing the Fed or criticizing fiscal policy. And not that I make a living trying to wear a tin hat and poke holes in everything the Fed does, quite the opposite. But still, I don't think you get quite as unique a perspective. Now, that is in essence the different nature of these questions, is that there's some people with longer backgrounds. A guy like Tobias, for example, been through plenty of business cycles, 20 years in that seat. So he was going to be useful in thinking about equities through various business cycles. But, the level of intervention from the monetary policy authorities into the markets was such that, unless you'd ever really been and spent time in fixed income trying to gauge what was likely to happen in the equity markets was particularly difficult. Even my views about the volatility suppression and what has gone on in the mortgage market, I just don't hear anyone talking about that. I haven't seen anyone on television. I haven't seen anything in print. Yet when I talk to people who are in the mortgage space, they swear by this, right? This is absolutely what's going to happen. And this is what happened when the Fed started shrinking their portfolio in 2018 that triggered Volmageddon. This is what happened back when they let their portfolio runoff occur in 2010. And so that's, for me, that's my distinct competence is being able to tie those pieces together.
Yeah. And I think getting some read through on the asset classes that may spill over into the one that you care about most is so critical. And, sometimes moves within a market are contained to that market, but sometimes something's brewing in another market that ultimately does spill back. And to have that perspective and being able to gather intel from other asset classes and have an appreciation for when that tipping point may occur, that's hugely important because those are the blind spots. That's what people are going to fail to see.
Correlation, right? I mean, you and I talk about it a lot, but correlations are low until they're high. And then when they're high, that's when things are truly chaotic. People generally don't see that coming. Dick Fold certainly didn't.
I was going to say that two things someone never said during a market crisis event. One was, hey, I'm more diversified than I thought I was. That's one. And and the second is, boy, this portfolio is more liquid than I expected it to be. Right? Probably the same thing
exactly
in some ways, right? But well, Barry, it's great to catch up. Really appreciate the insights. Our audience will appreciate the thought process again. Great to spend the hour with you.
All right. Thank you, Dean.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.